Over the years, as I have sat in closings with clients, I've told many of them, hey, did you realize that this mortgage is assumable? It may be a great benefit to you down the road. And we have finally reached a point where an assumable loan may be a phenomenal opportunity for the sellers and the buyers. My name's Miles Pitcher. I own Superior Lending. I'm located in Utah, licensed in Utah and Colorado. Please subscribe to our channel here. Thank you for doing that and for those who support this. So, assumable loans. Here are the options you have. The government-backed loans, FHA, VA, USDA, all work. We're going to take a dive into FHA today. Conventional does not work. Conventional has a due on sale clause, and I'll link a video here for you where you can go watch and learn the situations where you can for the loan without triggering the due on sale clause. But if you are selling the home and you try to have that mortgage assumed by a buyer that's not related to you, you will trigger the due on sale clause. I'll let you watch that video to understand that better. But let's talk about FHA and our assumable loans. So a few key points. When you get an FHA loan, you sign an agreement there, you are going to occupy the home owner occupied for at least 12 months. You have to have met that. The new buyers can't just do this assumption without going through an application process. They have to be credit worthy. They have to have credit scores, income, and be able to qualify for the mortgage. There is a form that has to be filled out and submitted and qualified. You do this through the current servicer of the loan. You do not do it through a loan officer, your local mortgage company, which I'm telling you things that really don't benefit my business because you're working directly with the servicer of the loan. Now, in this, you also have to come in with enough money to pay the equity to the seller. And we'll walk you through an example to show you how this works. But that can be a sizable chunk of money. The cool thing is obviously when you assume the loan, you get the interest rate and the monthly payment that the seller has had. And for many of our FHA clients who have been in their FHAs for a couple of years, those rates are super low. Many are in the twos, many are in the threes. The other part of this is you have to go through the right channels for the seller to be released from the liability of the mortgage. And you really want that. And there's a certain form from FHA, HUD that you apply with. And then when they release you from the liability, you get this form from them. Some of the pros or benefits of this is you're going to get a killer interest rate. You will also, for a seller, have some incredible marketing. To be able to say that you have an assumable mortgage should allow you to market your home and possibly even bring a premium to your sales price. Typically, your closing costs are going to be lower because there is no loan officer involved in this. Form-wise, you're still doing a purchase contract to buy the home, but you're going to just say, hey, this is a loan assumption. We're going to apply and qualify, and it will identify how much you have to bring in as down payment. So there's going to be lower closing costs. Over the long term, huge savings potentially. And then this is a big one. And we won't go into this too much, but FHA allows you to come in with a simultaneous second mortgage or HELOC to be able to cover this large down payment that you have to show up with. Because again, you have to be able to pay the seller their equity in the home, and it can be a chunk of money. Some of the disadvantages is that, yeah, that equity chunk can be large. You're working with the seller, or sorry, not seller. Well, you are working with the seller, but you're also working with the servicer. It can be slow and frustrating. The other disadvantage, and it may not be that big of a deal, but FHA loans typically carry mortgage insurance on them. As you take over the loan, you are going to have to continue paying that mortgage insurance. But the rates on these are so low that it may be worth it to do it. Okay. So let me give you an example from the past. I have a client who bought a home. It's a townhome bought in February 2020, purchase price $260,000. They did 3.5% down. And then if you remember correctly, FHA charges a 1.75% upfront mortgage insurance premium, UFMIP, that gets added to the loan amount. That puts their starting loan amount at 255. We estimate their value right now is around 405. That's probably a little bit conservative. They've just been making normal monthly payments, no extra payments. Their balance right now is around 243. Current monthly payment, including taxes, insurance, and the PMI, the mortgage insurance, 1441 a month. Their rate is 3.167. Those are phenomenal. So let's look and see. Let's compare if we assume that loan versus a brand new FHA loan with 3.5% down. And then the third option is this new FHA loan, but doing the same down payment as what you would be bringing in on the assumption. So I've highlighted a few key points. So we're going to buy it from the seller at current market value. The difference in equity that we need to give the seller is 161,685. So we're taking over the exact same loan balance he currently has right now. By bringing in that large of down payment, you take over and get that 1441 a month payment. You pick up the interest rate of 3.167, and you have 333 payments left. You keep on the same schedule the seller was on. So less than 30 years, about 28 years. Compare that against your new, if you just came in and said, hey, we'll buy it from you for 405. You do the minimum down payment. And I guess this is the advantage of a new loan is you can do it with a much smaller down payment. But look at what the monthly payment is and where the current rate is, 5.125, 2150 a month. That is a massive difference in monthly payment. And of course, you're 30 years out on getting this loan paid off. But what if we took the same 161,000 and applied that as a new FHA loan? How would that compare? So with that large of a down payment, your monthly payment is still going to be around $250 a month higher than doing the loan assumption. So you can see the massive savings that you have. I forgot to mention that when you do a loan assumption, FHA wise, you need to qualify and you need to own or occupy the property. They used to allow on some of the really, really old FHAs for investors to acquire them, but now you have to own or occupy them because that's what FHA requires. So if I was buying a home, I would tell my agent to look and see if they can find anyone who has an FHA loan who is getting ready to sell their home. And I would look and see, do I have the ability to come up with a large down payment? Do I have the ability to get a second mortgage to be able to cover a big chunk of that? And I would totally explore these numbers and see. If I was a real estate agent, I would be looking for every client that I can that has an FHA loan, VA loan, USDA loan, and make sure they understand that, hey, as your real estate agent, I am going to sell this house for you, but we are going to advertise that you have an assumable loan. Boy, that's going to give you an advantage and really some marketing opportunities over other listings and homes for sale. All right, I want to give you a rate update on where we're at. So again, this is an inverse chart. This is our mortgage-backed securities chart. As the chart moves down, rates move up. And you can see that we had a trend of getting worse in rates, and we came down and hit this resistance line. And then right here where we had these improvement in rates, that's where the Federal Reserve raised the Fed funds rate 75 basis points. That a lot of people are like, why does the federal funds rate improve mortgage interest rates? So just understand that it works this way. And I always put this in here. Inflation is the enemy of mortgage rates. And that is what's been hurting our mortgage rates. What happened last week was by the Federal Reserve raising the Fed funds rate 75 basis points, they showed and in their comments said they are committed to get inflation under control, to curb inflation. And that commitment to bring inflation under control helped improve our mortgage rates slightly. We will see what the future holds. We'll see how well they hold to that commitment. We are watching to see what the July Federal Reserve meeting does. We anticipate and expect that they're going to do at least 75 basis points. That is what the market is anticipating. If they do less than that, it's going to be bad for mortgage rates. It'll hurt. If they do 100 basis points, it will help mortgage rates because, again, it shows the Federal Reserve getting aggressive about getting inflation under control. Please feel free to reach out to me if you have any scenarios, questions that we can help you with. Always happy to help you, even if you're not in Utah or Colorado. We love helping people with their loans and making sure that they are educated, they understand, and are getting the best loan for their situation. Have a great week. We'll be back again with another tip for you next week.